A lot of people believe there's a safe way to put cash into the bank. Never go over $10,000 in one shot. It sounds cautious and smart, and that idea gets passed around at family dinners, in retirement communities, and between friends as if it were an official rule. Exhales, what most people, especially retirees, don't realize is that this exact habit can create the very risk they're trying to avoid. The moment someone starts chopping up a larger amount of cash into smaller deposits purely to stay under that number, they can drift into an area federal law takes very seriously. And in many of the real-world cases that get flagged, the people involved weren't trying to hide anything. Curious, they weren't running a business under the table or doing anything shady with the money. Maybe they sold a truck they'd owned for years, got some help from their adult children, or moved their own savings from one bank to another. Very normal situations. But the banking system doesn't see the life story behind the money. It only sees dates, amounts, and patterns. And sometimes those patterns can send the wrong signal. I want to walk you through how this actually works, because once you understand the rule behind the $10,000 number, the whole topic becomes a lot less mysterious and much easier to handle. A little later, I'll share the story of a retired teacher who ran into problems simply trying to tidy up her accounts after her husband passed away. Her experience shows how easily a careful, honest person can get tangled up in this without meaning to. Hi, I'm Artur, and I spend a lot of time digging into financial rules and banking habits that quietly trip people up in retirement. Not because the rules are secret, but because the way they really operate is often very different from the advice people swap with each other. Over the years, I've noticed that certain money tips spread quickly in communities and families. Someone hears something from a friend, that friend heard it from a bank teller years ago, and eventually it turns into the rule everyone believes. The $10,000 deposit idea is one of the most misunderstood examples. People hear about it, then try to work around it, not realizing that the workaround is often the one thing that can cause trouble. Nothing in this video is legal, tax, or financial advice. It's general education to help you ask better questions and, when needed, talk with a qualified professional. In this episode, I'll explain what the $10,000 rule really is, what banks are actually required to report, and why the report itself is usually not the problem. Then we'll walk through the 3 real-life situations where retirees most often run into confusion: selling something for cash, receiving money from family, moving savings between their own accounts. Along the way, I'll show you the simple documentation that can protect you if questions ever come up later. Once you see what the system is actually looking for, the solution is surprisingly straightforward and often the exact opposite of what people have been told for years. To start, we need to be clear about what the $10,000 threshold actually means. Behind the scenes, banks in the United States are required by federal law to file a currency transaction report, or CTR, whenever a customer deposits more than $10,000 in cash in a single transaction. The key point is cash. We're talking about physical bills, not checks, not wires, not electronic transfers between accounts. If you walk in with more than $10,000 in paper currency and deposit it at once, the bank is required to file that report. This happens automatically and quietly. The bank doesn't call you first. They don't ask permission. In many cases, the customer never even hears about it. The report simply becomes one more entry in a large database that regulators use to monitor big cash movements across the financial system. Millions of these reports are filed every year. The overwhelming majority go nowhere. No phone call, no investigation, no follow-up. They're just records. The rule was originally designed decades ago to help law enforcement detect large-scale financial crime. Things like organized money laundering or major illegal enterprises that move large amounts of physical cash, because cash can be harder to trace than electronic transfers. Here's the crucial part most people never hear. The report itself is not an accusation. It doesn't mean anyone thinks you did something wrong. It doesn't automatically trigger an investigation. It's simply a record that this amount of cash went into this account on this date. Where the confusion starts is what happens after people hear about the rule. At some point, someone reasoned that if banks only report deposits over $10,000, the smart move must be to stay under $10,000. That logic spread quickly. You've probably heard versions of it. If you have $11,000, just put in $9,000 now and the rest later. Split it between accounts so it doesn't get noticed. Have your spouse deposit some at another branch. On the surface, it sounds like simple problem solving, but the law specifically anticipated this behavior. Once someone starts breaking up a larger amount of cash into smaller deposits with the intent of staying under the $10,000 reporting threshold, that falls into a different category under federal law. That behavior has a name: structuring. Structuring, deliberately arranging transactions to evade reporting rules, is treated as a serious issue in its own right. The reason is simple. This is exactly how many criminal organizations use to move large volumes of cash through banks without triggering the $10,000 reports. Instead of one $50,000 deposit, they would make a series of smaller deposits, sometimes at different branches and on different days. Modern banking systems are designed to spot those patterns. Software looks at the timing and amounts. It doesn't know if the person is a career criminal or a retired librarian. It just sees a series of cash deposits landing repeatedly just below the reporting line, and it flags that pattern for review. This is where it becomes especially frustrating for retirees, because the people who get caught up in this are often the ones trying to do the right thing. They've worked and saved honestly for decades. They hear well-intended advice about staying under $10,000, and the way they deposit their own money ends up looking like the exact thing the system was designed to detect. That's why understanding this rule is so important. Depositing a large, legitimate amount of money is not inherently dangerous. The risk comes from misunderstanding the rule and trying to work around it in ways that can create questions later. Let's talk about where this really shows up, because there are 3 situations where retirees run into this over and over again. The first is when someone sells a personal asset for cash. This might be more common than you think. Maybe you sell the pickup you don't need anymore, the boat that's been sitting and used, an RV that hasn't left the driveway in years, or an old classic car. These kinds of private deals often happen in cash when the buyer wants a quick, simple purchase without involving financing. So imagine this. A buyer comes, inspects the vehicle, you agree on a price, and they hand you $11,000 in cash. Completely legal, completely normal. The title is signed over, you hand over the keys, and the deal is done. The obvious next step is to take the money to the bank. You deposit $11,000 in cash. The bank's system automatically files a currency transaction report because the deposit is over $10,000. That's the end of it. No confrontation, no accusation, probably no comment from the teller at all. It's routine. But later that week, you mention the sale to a friend. Over coffee or at church, someone says, you shouldn't put that all in at once. If you keep it under $10,000, the bank doesn't have to report it. Sometimes people name $9,900, sometimes $9,500 to be safe, but the message is always the same: stay under the number. So next time, you try to follow that advice. Maybe you sell a piece of equipment or receive another cash payment. Instead of depositing the whole amount, you split it: $8,000 today, $3,000 next week. To you, it feels cautious and smart. To the monitoring software, that can look like someone deliberately trying to avoid the reporting rule. That pattern, not the money itself, is what attracts attention. The safer and simpler approach is often the opposite of what people have been told. If you receive $11,000 for a vehicle, you generally want to deposit the full $11,000 in one go. Let the automated report be filed. There's nothing inherently wrong with that deposit. What really protects you is the paperwork. A bill of sale showing who bought the vehicle and for how much, the signed title transfer, the bank receipt or statement showing when the cash was deposited together. Those documents tell a clear, straightforward story. On the rare chance that anyone ever asks about the deposit years later, you have a neat, written record showing exactly where the money came from. The second situation where this rule creates confusion is within families. As children grow older and become more financially secure, it's very common for them to want to help their parents. A roof needs to be replaced, medical costs come up, or maybe an adult child has a successful year and wants to share some of that good fortune. A son might say, "I'd like to give you $15,000 to help with the house." A daughter might send money to cover medical expenses that insurance didn't fully pay. These are everyday, legal situations. In fact, the tax rules around gifts are often misunderstood in the other direction. In many cases, the recipient of a gift does not owe income tax on that money. A genuine gift is usually not considered taxable income for the person receiving it. The confusion starts when everyone tries to simplify the transfer. A child might say, "I'll send it in a few smaller chunks so the bank doesn't hassle you." A spouse might suggest, "Let's put some in my account and some in yours so it doesn't look too big." All of this comes from a good place. They're trying to help and avoid what they think will be extra attention. But those very strategies can create the same structuring pattern we talked about earlier. A cleaner way to handle a legitimate family gift is usually to send it in one clear transaction. If it's done by check or wire transfer, the documentation is built in. The bank systems can see the money going from one account to another, and a simple paper trail exists automatically. If the gift is given in cash, it can still be deposited all at once. Keeping a short written note is often enough to document it. A dated and signed sentence such as, "I gave to my parent as a personal gift on," paired with the bank deposit record. That note clearly explains what happened if anyone ever asks in the future. The third situation, and the one that surprises people most, is when you're simply moving your own money between your own accounts. That's exactly what happened in the case of the retired teacher I mentioned earlier. She had spent more than 40 years teaching. In her late 60s, after her husband passed away, she was left to organize their finances on her own for the first time in decades. Over the years, like many couples, they had built up accounts in different places, an old checking account from when they bought their first home, another opened later for convenience, a certificate of deposit that had been renewed a few times. Financially, nothing was complicated. Emotionally, it was exhausting. When you've just lost a spouse, even routine tasks can feel overwhelming. Her goal was simple: move everything to one bank so she could track it more easily. That kind of consolidation is very common, and many professionals actually recommend it. Fewer accounts means fewer statements to juggle and a clearer picture for future planning. But the way she moved the money caused a problem. Instead of transferring the full balances at once, she moved the funds in several smaller steps: $9,000 one week, $8,000 another, then another amount just under $10,000 a few days later. She wasn't trying to avoid anything. She wasn't thinking about the $10,000 rule. She just assumed that smaller moves would be easier to manage while she was grieving and dealing with paperwork. About 6 weeks later, she got a letter asking her to explain the pattern of deposits. Imagine how unsettling that feels. You know the money is yours. You know it came from years of work and saving. But suddenly there are questions about how it moved. In many cases like this, once the explanation and documents are provided, nothing more comes of it. But the experience is still stressful, especially when you're already going through a difficult time. The key point is that the system didn't know anything about her personal situation. The software didn't see widow, retired teacher, consolidating accounts. It saw multiple cash-like deposits repeatedly, just under $10,000 in a short period. To the monitoring algorithm, that pattern resembled structuring. This is one of the most important things to remember. Much of modern banking oversight is data-driven. The software looks for patterns that historically matched financial crime. Repeated deposits that seem designed to stay under $10,000 are one of those patterns. When that pattern appears, the system flags it. Moving your own money between your own accounts is absolutely legal and very common. People do it every day when they change banks or roll over maturing CDs. The transfer itself isn't the problem. It's the pattern of repeatedly keeping amounts just under the reporting threshold that can raise questions. So when you need to move a larger sum between institutions, it's often simplest to move it in one clear transaction if you can. A wire transfer or a cashier's check does this neatly. It shows exactly where the money came from and where it went in one step. A bank employee may ask a brief question like, "What's the source of the funds?" That's normal. A short, honest answer is usually enough. "These are my personal savings being transferred from my other account." You don't need to give a long story, just a clear statement backed by your paperwork. For documentation, basic records usually do the job. A statement from the original account showing the balance and the outgoing transfer, the wire transfer confirmation or cashier's check receipt. If it came from a maturing CD, the maturity notice. Those documents together show the path of the money from start to finish. This leads to a bigger point. What really protects you is not avoiding reports. It's having a clear paper trail. Once you understand that, the $10,000 rule becomes much less intimidating. Instead of worrying about triggering a report, you focus on making sure your transactions can be easily explained if someone ever asks about them. In most situations, 5 simple pieces of documentation are enough to tell that story clearly. Something that shows why the money exists. A bill of sale for a vehicle or equipment, a short gift letter from a family member, a notice of a maturing CD, or an account closing. This connects the money to a real-world event. A statement from the account where the money came from. This shows the funds were already there before the transfer or withdrawal. Proof of the transaction itself. A wire confirmation, cashier's check stub, or deposit receipt with the date and amount. Matching information in your tax records when relevant. For example, if you sold property or business equipment, having the sale reported properly on your tax return helps your story line up across documents. A clear, simple explanation if a bank ever asks. In most cases, a short written response backed by those documents is all that's needed. If a situation ever becomes more complex, that's usually the point to speak with a CPA, tax professional, or attorney before saying more. When you put these pieces together, you see that none of them are complicated. They don't require a lawyer. They're simply records of normal life events, selling something, receiving help from family, or reorganizing your savings. Before we wrap up, there are a few myths about the $10,000 rule that cause more confusion than almost anything else. Myth 1. If I deposit $9,900, I'm safe. In reality, $9,900 is one of the most commonly watched deposit amounts, precisely because so many people believe this myth. Banks don't just look at deposits over $10,000. They also look for patterns that suggest someone is trying to avoid that line. Repeated deposits just under the threshold can stand out more than one honest deposit over it. Myth 2. Only people doing something illegal get questions from the bank. That would be comforting if it were true, but the monitoring systems are largely automated. They don't know your personal history or intentions. They're looking for activity that fits certain patterns. That means perfectly honest people sometimes get routine requests for clarification. Once they provide a clear explanation and documentation, the matter typically ends there. Myth 3. Once I'm retired and on a fixed income, these rules don't really apply to me. The reporting rules don't include an age or retirement exemption. A cash deposit by a 75-year-old retiree is handled under the same rules as a cash deposit by a 35-year-old business owner. The system just records the transaction. The good news is, once you understand how it works, you don't need to be afraid of it. You just need to keep your records clean and avoid patterns that look like structuring. If you strip away the rumors and half-true advice, the core idea is actually simple. The reporting system was built to track large physical cash movements, so serious crimes could be detected more easily. It was not designed to target retirees who sold a truck, accepted help from their kids, or consolidated accounts after many years at the same bank. The report itself is rarely the problem. If you deposit more than $10,000 in cash, the bank files the report and, for most people, nothing else happens. Complications tend to appear when people try to outsmart the system by breaking up deposits or transfers just to avoid that report. That pattern is exactly what the software is meant to notice. So, if there's one practical idea to take away from this, it's this. Avoid breaking up a legitimate cash deposit into smaller chunks just to stay under the reporting number. Instead, handle genuine transactions openly and keep a short set of records that explain what happened. In practical terms, that often comes down to 3 habits. When you receive legitimate money, deposit or transfer the full amount rather than slicing it up to dodge the $10,000 line. Keep simple documentation, a bill of sale, a brief gift letter, statements, and transaction receipts. Think of them as a short written history of where the money came from and where it went. When moving your own savings between banks, try to do it in one clean transaction when possible, and keep the confirmation from the bank. When people get into trouble around this rule, it's usually not because they intended to do anything wrong. It's because they acted on advice that sounded smart but was backwards. Advice like, always stay under the number, or split it up so no one notices. Transparency plus documentation is what keeps things simple. Now that you know how this rule actually works, you're already ahead of most people. You don't have to guess or rely solely on word of mouth. You understand what the system is built to look for and how normal, honest transactions fit into that picture? I'd like to hear from you as well. If you're comfortable sharing, tell me in the comments what state you're in and what type of situation you deal with most often: selling property, receiving gifts from family, or moving savings between accounts. Everyone's circumstances are a little different, and your experiences help me understand which topics to cover in more depth next time. Thanks for spending this time with me, and I'll see you in the next video.